Hello, everyone. I'm Joe Welu. Thanks so much for tuning in to Expert Insights, where we talk with industry leaders across modern financial services to discuss leadership and innovation. Let's get started. All right. Hey, everyone. Welcome to Expert Insights. I am joined by two of my best pals here, Mr. Dan Catinella, our Chief Lending Officer, and Mr. James White, our GM and industry principal for banking. How you doing, guys?
Great. Monday.
You know, there's been a little bit going on in the world in the last, call it 10 days, 2 weeks or so, and thought we would come together and have a discussion around Silicon Valley Bank, SVB, as they are known, and the people that know the organization, talk about that and what happened, and then also talk about what the opportunity is right now surrounding sort of all this dislocation that we're seeing. So I want to start out and talk about Silicon Valley Bank, the collapse. And as of a couple of weeks ago, a lot of people didn't even know who Silicon Valley Bank was or why it was important. And they are, for those of our audience that don't know and haven't been reading the news, they fund and are the preferred bank to much of the tech community. You know, I think upwards of 50% of technology companies bank there. And so they had a very abrupt decline and ultimately were taken over by the feds, and that has caused some dislocation in the market. So I want to start out, guys, and talk me through exactly what happened, and just to simplify for those in our audience that haven't had it explained in simple terms. But James, I'm going to let you expand on this. But so from the way I understand it, they had really ultimately a mismatch in duration of the deposits. They invested in securities, in treasuries and MBS, in bonds, essentially. And they had a duration mismatch, meaning they were in longer term securities, and they had a bunch of deposits that were potentially needed in the shorter term. And when interest rates started going through the roof, those bond prices fall. And which is not a problem if you can hold those bonds to maturity. But if you need to access the cash, meaning you need the liquidity, you ultimately have to sell them at a discount, right? Which is what happened, which is what kind of propelled this thing. So I'm generalizing, but give me your take on it and tell our audience what happened.
So from one thing I think, if you don't understand banking, is that can be a little bit of a confusion point, is that deposits are actually liabilities and loans are assets. And oftentimes people may get that flip-flopped. And so what that means is when you receive in deposits as a bank, there's a cost associated with holding those deposits. You think about just the systems that process the deposits, generating statements every month, all those things. So they have to find ways to invest them. They have to earn some type of income off of those deposits. Otherwise, they'll just continue to lose money. And so what happened was, to your point, Joe, they received a tremendous amount of deposits, and they weren't able to offer enough loans to offset those deposits to generate income. And so they have to find other vehicles to invest those dollars in. And
let me drill into that just a little bit. And ultimately, I want to get to the point where we talk about, you know, everybody may be saying, hey, yeah, this has been in the news a lot. And I think our focus today is ultimately to talk a little bit more about what happened, but then get to why is there opportunity for those that are paying attention. So, you know, what you're saying is ultimately there was so much money coming in the door, like literally they didn't hardly know what to do with it. Is that what you're saying?
Yes. Yeah, they couldn't generate enough loans fast enough to offset it. So they have to find ways to invest to get some sort of return. Bonds are typically a very safe way to do that. If you can hold them until term, then you can not have to worry about a high risk. Say if you lend out the money, you may not get it back, as an example.
So in hindsight, they should have invested in much shorter term bonds though, right?
Yeah. Oh yeah, for sure. They wouldn't have got as much of a return, but they would have been able to invest in those shorter bonds.
Essentially, this is my understanding again, and I'm making no judgment as to leadership decisions at Silicon Valley Bank, just trying to understand the facts here. But basically the mistake, if there was a mistake, and clearly a lot of people are saying there was underestimating the potential increase in rates and the velocity, of those interest rate increases. Is that where the mistake was?
Yeah, well, that's one of them. The other was not having a diverse portfolio, both of customers and investments. They were really very narrow from a portfolio perspective. And really what you see when the rates rise this quickly is people typically, even for other financial institutions, are going to chase those rates. If they have no loyalty, they're going to take those dollars and move them over to another institution where they can get 2 or 3% more, especially on millions of dollars.
Yeah. So I was having dinner last week with one of our bank customers. They're about a $2.5 billion institution, and I wanted to know. I'm like, hey, have you guys had pressure, right? And he was like, basically, no. They didn't feel it. They actually were the beneficiary of this. And so in your mind, I know the regional banks have had pressure on them. We saw First Republic and I guess they're super regionals, depending on how you categorize them. But where's the pressure at? Let's separate Silicon Valley Bank from the rest of the banking world, because arguably you can look at SVB and say they were really unique. Their customer base was not very diversified, as you mentioned, or at least that's what we understand. And how does it compare to the rest of the banking ecosystem? And where's the pressure coming from? And sort of what are you seeing, James? And I know you monitor this closely.
Yeah. So first off, I want to be clear. I'm not even remotely saying that other financial institutions are about to be in the same situation Silicon Valley Bank is. I think Silicon Valley Bank is the situation that other banks and credit unions are seeing on steroids, which is people are starting to chase higher deposit rates. And the first ones to do that are commercial deposits because they're larger balances. And so when we talk to financial institutions and I'm able to look at it and analyze their balance sheet, a lot of them are having deposit runoff. And that's because of those rate chasers. So that is very much a problem for just about all banks and credit unions. But that doesn't mean that they're going to be in the same situation as Silicon Valley Bank is, because they have more of a diverse portfolio, less risky investments. They also have less large dollar depositors. It would take a lot of depositors to leave a your average bank.
Well, and I don't have the numbers in front of me, but a lot of the community banks, regional banks, a lot of their depositor base falls under the $250,000 FDIC insurance limit. So their deposits are protected, right?
Oh, yeah. The average bank, their average deposit, and this includes commercial deposits, is about $35,000. So it's nowhere near. It was 1.2 million for Silicon Valley Bank was their average depositor.
And I just think it's important to put some context around this, because there's just a lot of all of us we talk about the media and the hype and the sort of panic that starts to set in, and how people don't necessarily look at the data and the facts. They start acting with emotion and essentially panicking, right? And so this is important to really understand what is really happening and what's at risk. Now, the government stepped in and backstopped the depositors for SVB, and there's some rules of thought that maybe they shouldn't have done that, maybe they shouldn't have done that. I happen to be in the camp that says it was the right thing to do with the information that we have. If you didn't do that, you would have had ultimately a pretty chaotic, call it, extinction level event for a lot of organizations, because it would have just had this contagion. It would have spread, right? You agree with that? And what's your opinion on that?
So I agree 100%. So it's really all about consumer confidence. So, and that's really the narrative that you see out there. a lot of media outlets, a lot of other institutions are going to continue to throw SVB under the bus. And the reason why they do that is because it's important to make sure that the consumers feel confident that the banking system is strong, because it's really all built on trust. And the banking system is strong. So covering those deposits was crucial, I believe, because you want to make sure consumer confidence stays strong, because it takes a lot of $36,000 deposits to leave a bank for a bank to have liquidity problems. But it can happen with the media if you let it continue to spiral out of control. So.
All right. So, Kat, what's your opinion on how the lending side of the equation has been reacting? We saw a lot of volatility in interest rates last week, arguably driven and catalyzed by the SVB debacle. Is that your take? And give us some perspective there.
Yeah. So, housing and lending typically always enjoy the benefits of a good crisis. I will just say so.
Never waste a crisis, man.
But yeah, volatility has been pretty dramatic over the last week. Looking at the markets from some of the swings, rates swinging up to the 7% range, then falling pretty dramatically towards the end of the week, down where they landed about 6.5 range on 30-year fixed mortgage. We've also seen those are immediate responses to home buyers that came back into the market as rates dropped and applications rose 6.5% just last week alone. So
applications were up. I haven't looked at the data yet, but applications for mortgage were up 6.5% week over week.
That's right. Yep.
That's meaningful.
We've had some of our top clients report that they had some of their best lock days in almost 9 months. Just last week alone. So we all expected mortgage rates to drop to the lower into a 6% range sometime in the second half of 2023. I think with what's going on in the banking market, some of the fears of a recession looming, I think we're going to see that really come at a much faster pace this year. But I think the next 60 days are still going to be pretty volatile.
They're going to be volatile. I would agree with you. So, yeah, I think we have a high level overview of what happened, and there's certainly massive amounts of research out there that people can go and dig into that if they're trying to understand it more deeply. That wasn't necessarily the point of this discussion, but wanted to level set there. And now I really want to focus on, we spend most of our time as an organization, of course, we look at all the data, what's going on, but then how do we find the opportunity? Right? How do we find the opportunity for our customers, and how when we partner strategically, where are the opportunities for growth? So I want to talk about that. So James, when it comes to banks, credit unions, all right, how should they be using this as an opportunity?
Yeah, so this is a great opportunity to build further loyalty, especially with your younger customer and member base, because right now, well, we've dealt with loyalty issues with the younger demographics for a long time. We just the way a relationship is built with them is different than what we have seen historically with banks and credit unions. And so now is a great time to lean in with financial wellness and financial education. Differentiated deposit strategies like relationship pricing would be a great example.
Let's talk about that one, because people talk about loyalty all the time. We can have a whole conversation on that. And I agree 100% that it is important. And when I think of loyalty, it's really, you got to build authentic relationships with customers, and you can't fake it. It has to be intentional. It has to be organization wide. It has to be a directive. We agree on that. But you said something on relationship pricing, okay, as it relates to a deposit strategy. Walk me through that.
Yeah, so there's a couple of different ways that you can leverage relationship pricing. So one is just at the individual level. How engaged am I with the institution? So the more products and services that I obtain, leverage, and use at the financial institution either benefits me in reward points if I have a rewards program, or benefits me in reduced fees or reduced uh, loan rates or increase deposit rates. And so what that does is, one, it encourages me to leverage more products and services from the institution, but two, it makes it more sticky because I'm not going to move my savings account from a bank if it's going to cost me an extra interest point on my auto loan, as an example. And so now you start to get very sticky. That's one way. You also can branch that out into the whole household and even the family. So now you're starting to engage the whole household.
Okay, so let me just give you my ideation on this and just tell me if I'm correct in thinking about this. So if I'm a bank, credit union, and I have of course I'm lending money. Most of them are lending money in some capacity. I'm seeing volatility in interest rates right now. Potentially, I don't think we talked about this, but ultimately what all this dislocation in the banking system and the chaos that it's creating, a lot of people are feeling it's going to be a catalyst to pushing us into a recession. And if that happens, arguably, and I don't think it's a question of if, I just don't see how we avoid it, rates are going to come down, right? Lending rates are going to come down. Mortgage rates for sure are going to come down. And so what you're saying is, if I'm in the lending business and I can have a dual pronged strategy of I can drive income from my lending business, but I can also help fix my deposit problem, okay, by having a preferred rate on those mortgage rates, on those lending rates, okay, interest rates. And I can use that as a catalyst or a driver to increase deposit growth. Is that what you're saying?
That's exactly what I'm saying. Think about if you, as an example, reduced origination fees in exchange for a direct deposit. So now that consumer is going to move their income deposit into your financial institution in exchange for a lower origination fee.
Yeah, and if you that's really great. This is a concept that's not new, obviously, but what I do think it has not. I don't think banks and banks, credit unions, organizations, deposit institutions have done a great job of packaging it. Would you agree?
Oh, I would agree completely. And they haven't had to. So that's the big thing, is that they were flooded with deposits and flooded with loans. They were throwing people at the lending problem because they just couldn't get them processed fast enough. And they didn't know what to do with all of the deposits. And so now loans are slowing down and deposits. There's no more stimulus checks. There's no more PPP loans, and people are starting to spend some of that savings as well as move it around chasing rates. And so now they're having to leverage these muscles they haven't had to leverage in quite some time.
So if I'm a banker lender or I'm a bank or credit union and I'm looking at my lending and my deposit growth strategy, I would say at the top of the list strategically, I should be thinking about what does my playbook look like to wrap a VIP type of offering for that relationship pricing. I'm going to get customer acquisition based on that lower rate, okay, that I can offer if I get the deposits. And I'm going to bolster my balance sheet. I'm going to bolster my deposit base, right?
Absolutely. And it's now a lot stickier product too. So they're going to be less likely to chase rates.
Yeah. So obviously we agree this is an opportunity. And I think it really underscores conversations that we've had over this past year about being incredibly nimble right now and the ability to pivot strategy based on what's happening in the markets, meaning, hey, are you nimble as an organization to be able to go from ideation, from concept to campaign to execution of that campaign? Do you think that's a struggle for most companies? I mean, my opinion is yes, but I want to hear your perspective.
Oh, for sure. And a lot of it is cultural, just being able to get out of our own way sometimes and being, more focused on the consumer or the customer or the member versus the back office processes. Deliver something that's meaningful to the market and then build the back office behind it versus allowing the back office to dictate what's going to be delivered to the consumer.
Yeah. So we talk about this a lot internally, just the velocity at which you have to iterate and be able to adapt is increasing so much. And I think this is a perfect example of where the banking world, credit unions and banks need to embrace that mindset and really lean into it to take advantage of things like this. So Dan, Talk to us about the opportunity that is just on the horizon potentially for the independent mortgage lenders that are out there. They're not taking deposits, but they're highly sensitive to interest rates.
Yeah, so
Unpack that
just looking at some
opportunity
recent
for us.
IMB data, only 1 in 4 were profitable in Q4 of last year. But in discussion with many lenders, they're either breaking even or they're in striking distance from profitability. So ultimately, as rates drop, we've seen hopefully that continues, even though there will be some probably up and down over the next 60 days. Hopefully this is the boost that the lenders needed to really enter their spring market and start seeing some profitability. But ultimately, every lender needs to lead with education and advice right now, and especially as you got a large portion of the purchase market made up of first-time home buyers that need a whole different level of education right now. So making sure that you're packaging some of these macro factors and translating them into ultimately all the individuals want to know is how can these economic tribulations ultimately lead to my success, my meeting my financial goals in the future. A great opportunity to really use these to touch point with your consumers, explain what this means for them, and ultimately show them how the real estate and housing market ultimately could build the most financial success for their future.
Long-term financial health and fitness, right? We agree home ownership's a great strategy there, but ultimately the pattern that I'm seeing here, the opportunity really on both sides of the table, banks, credit unions, independent mortgage banks, the opportunity to put the stake in the ground and be that trusted financial partner, be that source of information, be that source of advice, that trusted ally ultimately. That's really a big opportunity right now if you can go to your referral partners, your relationship partners, accountants, wealth managers, whatever it is in your local ecosystems, and be the source of actual factual information ultimately. And then taking that, of course, down to the consumers and educating them on saying, hey, yes, there is a lot of panic in the world right now when it comes to the financial markets, but let's ground on the facts. Okay, let's ground on the data. And if you look at the last 50 years and you compare renting to home ownership, it's not even close. I mean, it's not even close, right? And I mean, that's ultimately what you're getting at. And talk to me about the Gen Z opportunity, the first-time home buyer opportunity. There's a lot of people that are saying, hey, I've got customers that are in they have 2.5% mortgages on their home. They're not going anywhere, okay? I have a thesis on that, but give me your take on the first-time home buyer opportunity.
Yeah, so from a first-time home buyer standpoint, it's massive, right? But I think what a lot of lenders have not done so successfully is making sure that they're understanding how to reach those Gen Zers, because they're on different channels. They spend a lot of their time on social media outlets, really getting their education and advice. So they're just not in the places where some more traditional lenders have really existed. So looking at your strategy to engage those customers in the channels that they exist in is really important, and leading with education and advice. They need a whole different level of education and advice, and making sure that you're looking at your touch points and your customer journeys and understanding, that you're leading with education to engage them and offer them the right solutions that meet their needs. Positioning things like rent versus buy scenarios and showing them that, what their financial wellness and their wealth creation looks like over a 5 to 10 year plan. It's pretty dramatic, as you said.
We were talking with a partner of ours last week about closing the gap to home ownership, and how for large segments of the population in the U.S., how actually, even if it's a little bit more expensive, okay, for them to get into a home monthly, it's actually the long-term financial health benefit there tends to be so much stronger. And some of the reasons why is, the pressure these extended communities and families get on the primary earner, and that money just tends to get, whether it's cousin Eddie that is struggling and I end up giving him a loan or what have you. If you pay a little bit more for your rent or for your house payment versus rent, and I hadn't thought about this, but it made sense to me, right? Why home ownership is so important. And you think about segments of the population where it is literally the best place they can invest in a lot of scenarios, right? Because they can't just go spend it easily, right? They can't put it in a Robinhood account and, trade crypto and withdraw it. They can't, friends and family that are in need, while I'm all about helping friends and family, but you got to be financially secure first. And that home is a great spot. And I know you agree with that directionally. I know.
And remember, it's, you may be paying a little more for your home today, but it's also a fixed debt in a lot of cases too, assuming you attach yourself to a fixed rate mortgage, where rents, are going to continue to increase over time too. So, if you look at that over a 5 to 10 year span, you may be actually paying significantly more in your rents than the home you can purchase today.
Yeah, I mean, all you got to do is look at the investments some of the big fund managers, such as Blackstone, have put into rental properties, single family rental properties as an asset class. Okay. These are some of the smartest people in the world. Ultimately, they rarely lose over the long run, and they're betting on that asset class. So for a regular consumer to think, gosh, I don't know, some people are telling me I should rent versus buy. Like, really? These guys are the smartest people in the world, arguably, when it comes to finance, and they're saying you should own. And so, you got to look at and consider things like that. So wrapping up kind of the opportunity here, I want to get into one last little conversation about the loyalty, the relationship building in this opportunity. James, I'm going to start with you. We talked a little bit about relationship pricing. What are some key things as an organization? If I'm thinking about right now, today, this week, I'm meeting with my leadership team and I'm saying, what should we be doing? Where do you start? How would you prioritize things?
Yeah. So the first thing I would do is say, let's slant towards or lean in towards action and actually execute on some of these things, because we've been talking about these strategies for a long time. And so now I'm hoping that this situation in the market is going to be a good catalyst, for a lot of financial institutions to really start acting on. The second is build a differentiated deposit strategy that is focused on the younger demographics, because we've been talking about the transfer of wealth for a long time. It's here, and a lot of institutions haven't built that loyalty with those younger demographics. Lean into financial wellness, and that needs to be more than just a blog that you have out on your website. It needs to be active, engaged communication with financial wellness that's meaningful to those individuals. And then leverage this time to really focus on being as efficient and effective as possible. Now's the time to double down and invest in the right places, because the pendulum always swings back, and now's the time to do that. So make sure that you have the best processes and technology implemented, so when that pendulum swings back, you're able to handle the volume in the right way. But it's really all about just action, just act.
Moving quickly, right? Moving fast, and analysis paralysis is the death of a lot of companies, a lot of practitioners, a lot of the loan officers, advisors that we work with over the years. And you see these deep cyclical environments, and this happens to be a pretty significant one. And one of the things that we see that separates the big winners from arguably the losers is they don't take as much action. They don't adjust. They're not on offense, right? And so you just hit the nail on the head, and I agree with you.
Yeah, I would say, look
Kat, give me your
look
take.
at your strategy for engaging first-time home buyers. Gen Z, millennials make up, certainly the majority of that population. And look at your strategy for how your originators are engaging those demographics for sure. And also look at your lead conversions and look at ways that you can kind of maximize your lead conversions. Every deal matters right now. So how do you make sure that you're nurturing those prospects over the life of that lead? You got the sales cycles that are still lasting significantly longer than ever before. Buyers are struggling to find homes due to lack of inventory and affordability. So making sure that you're really looking at that customer journey and engaging those customers over a lot longer cycle than you have before. And then the other one that everybody should be looking at is really how do you use data and intelligence to surface opportunities within your database. I can guarantee you, if you've closed a transaction over the last 12 months, those will be ripe for a rate and term refinance, and will have significant cost reductions in the next 3 possibly to 6 months. So making sure that you're preparing for those opportunities now, so that your entire sales force is ready to really seize them, because time is of all importance when you try to look at how to use data to surface opportunities and engage the customers at the right time.
Yeah, I think both of the commentary that you guys have really leads me to fully support our thesis on you have to be a data-driven organization. You have to lead with data, intelligence, insights, and then you have to package that with the automation and enablement of your sales organization, meaning you're forcing process down to make sure that they're taking action on those insights. Hey, if I've got Bob here or Susie that is a first-time home buyer, I want to know if they're in the market. I want to know their financial profile. And then I want to be able to drive the touch points, the engagement. And I want to do it at an enterprise level. It's not enough. And we see this over and over again. We looked at a lot of data in the last few weeks. The organization that simply say, here's an Excel file of some opportunities based on our back of the house data team. Go ahead and call on these. Like, you might as well just throw that in the trash can. You really have to automate the entire process. And it's a leadership driven initiative, right? You can't just put some things in place and expect your customer facing teams to have the discipline. And, I think ultimately the organizations that are putting systems in place right now that are honing kind of their current tech stack and saying, I'm going to be able to analyze my current base of customers, segment those customers, and then drive communication, engagement, advice as the markets are moving. It plays into both sides, right, guys? Like banks, credit unions, independent banks. Yeah.
Absolutely.
Awesome discussion, guys. Really appreciate the conversation. Man, there's a lot going on, and it's equal parts terrifying and equal parts exciting, depending on how you look at it. So, we always say never waste a crisis. Lean into the opportunity, have a growth mindset, and let's go. 2023 is moving along. So thank you, guys.
Yeah, thank you.
Thanks so much for joining us today. Be sure to subscribe wherever you get your podcasts.